Everyone will tell you the same thing. Take your first $1,000 and invest it. Buy an index fund. Start compounding. Time in the market beats timing the market. I'm going to tell you the opposite. If you're starting with $0 right now, that first 1,000 should not go into the stock market. I know what you're thinking. This sounds like clickbait. Some contrarian hot take designed to get clicks. It's not. Here's the math they won't show you. $1,000 invested in the S&P 500 at 10% returns about $100 per year. That's real money. That's compound interest working. But $1,000 invested in a skill that increases your income. That's $20,000 per year. Maybe more. Same $1,000. 200 times the return in year one. And yet every financial advisor on YouTube will tell you to buy VOO immediately. Because they're solving for someone who already has money. I'm solving for someone starting at zero. If you have $0 right now, here's my exact plan. Month by month. No fluff. Before we talk about the S&P 500, we need to talk about your bank account. Let me break down why this order matters. When you invest $1,000 in the stock market at like 10% returns, you make $100 the first year. Year two, you make $110 because now you're compounding on, $1,100? By year 20, that becomes about $6,700. That's great. Compound interest works. Every finance channel on earth will show you this chart. But when you invest $1,000 in yourself, the math looks completely different. A self-paced online coding course costs $1,000. That course helps you get a job making $20,000 more per year than you're making now. Over 20 years, that's $400,000 in additional earnings versus $6,700 from the stock market. I'm not great at math, but I think $400,000 is more than $6,700. Financial advice assumes you already have surplus, that you can save and invest consistently every month. But when you're starting at zero, you don't have surplus. You have survival mode. And here's the thing about starting with zero that nobody tells you. It's actually an advantage. Sounds insane, right? But think about it. When you have nothing to lose. You can take bigger risks. You can make mistakes when those mistakes cost $500 instead of $50,000. You can pivot fast because you're not tied to protecting what you already have. Starting with zero means you get to build the foundation correctly from day one. No bad habits to unlearn. No expensive mistakes to recover from. This is why my 12-month plan looks nothing like what Vanguard tells you to do. Because Vanguard is designed for people who already have $10,000 sitting around. We're starting from a different place. Month zero. Before you do anything else, you need to know 4 numbers. Income. What you actually bring home after taxes. Not your salary. Your take-home. Expenses. Where that income goes every single month. Not where you think it goes, where it actually goes. Assets. Everything you own that has value. Your car, your savings, your retirement accounts if you have them. Liabilities. Everything you owe. Credit cards, student loans, car payments, medical debt. These 4 numbers create 2 equations. Income minus expenses equals your surplus. This is your wealth building ability. This is the gap. Assets minus liabilities equals your net worth. This is your financial security. Most people avoid these numbers. I avoided them for years. I didn't want to see minus $100,000 staring at me. But the moment I wrote it down, things started to change. Because here's what these numbers actually tell you. They tell you why you feel broke even when you're making decent money. Let me show you what I mean. Rent in 2000 averaged about $800 per month for a 2-bedroom apartment in Phoenix. That same apartment today costs $1,900. Health insurance in 2000 was around $150 per month for a single person. Today, it's $450. College tuition in 2000 was about $3,500 per year at a public university. Today, it's $11,000. Childcare in 2000 ran about $400 per month. Today, it's $1,400. Meanwhile, median wages went up roughly 8% per year over that same period. So your rent went up 137%. Your insurance went up 200%. Your childcare went up 250%. And your salary went up 8% per year. Congratulations. Financial gurus will tell you the problem is your daily coffee. That $4 latte is why you can't afford the $500,000 house. The math definitely checks out there. This is why surplus is so hard to create. The gap between what you earn and what you spend keeps shrinking no matter how responsible you are. Once you actually look at these 4 numbers, month 1 becomes obvious. You need to create gap fast. Month 1 and 2, you have one goal: save $2,000 as fast as humanly possible. Not as fast as possible while maintaining work-life balance and self-care and all that. As fast as humanly possible. 10-day sprints. Cut everything that isn't absolutely essential to survival. Here's where that $2,000 actually comes from. Look at your subscriptions. Netflix, like $15 a month. That gym membership you haven't used since January, $45. Spotify, premium, $11. That meditation app you downloaded to manage money, stress, $10. YouTube Premium so you can watch finance videos without ads, $14. Cancel all of it for 10 days. You can survive without them. I once went to a 10-day silent meditation retreat where they took your phone. You couldn't read anything, watch anything, talk to anyone, or even make eye contact. It was torture. But I counted down the days, and knowing there was an end made it doable. You can go without Netflix for 10 days. Stop eating out. Cook at home. Rice, chicken, eggs, vegetables. You can eat well for $20 a day. Most people spend that on one lunch. Over 5 months, cutting $300 per month in food alone gets you $1,500. Add the subscriptions, another $250. Sell stuff you don't use, maybe $200 one time. That's over $2,000 in 5 months. Now here's the annoying part about canceling subscriptions. When you try to cancel, Netflix asks if you're sure, then asks again, then offers you a discount. Spotify gives you 3 free months. The gym sends you an email about your fitness journey and how you're so close to your goals. They design the exit to be painful on purpose, because every month you stay subscribed is free money for them. They're not evil. They're just really, really good at behavioral psychology. But here's why $2,000 matters. It's not about the money. It's about your brain. When you have $0 saved, every decision is filtered through panic. Car makes a weird noise. Panic. Phone screen cracks. Panic. Dentist says you need work done. You just don't go. $2,000 gets you out of that mode. Not completely, but enough to breathe. Enough to start thinking 1 month ahead instead of 1 day ahead. Once you hit $2,000, your brain literally changes how it makes decisions. Months 3, 4, and 5. One obsession: earn more money than you've ever earned before. Not by working more hours at your current job, by finding your most valuable skill and selling it. There's a framework for this. 3 circles. Things you're good at, things you love doing, things people pay good money for. Where all 3 overlap is your sweet spot. But here's the reality when you're broke. You need to lean heavy into that 3rd circle. What people actually pay for. I loved dancing. I loved cooking. I loved a lot of things. But I also loved talking about money, and I knew that's something people pay really good money for, especially compared to opening a dance studio. So I leaned into finance. Don't be afraid to get mercenary about this. Here's what different skills actually pay per hour. Photography in a saturated market, about $50 per hour. Freelance writing with decent clients, $75 per hour. Coding, if you know what you're doing, $100 per hour. Consulting, if you have expertise, people need $150 per hour. Could be more, depending on the niche. Sales with base plus commission, $80 per hour base, but uncapped upside. You'll notice, follow your passion isn't on this list. That's because passion doesn't pay rent. Valuable skills that solve expensive problems pay rent. Follow your passion becomes follow your rent payment real quick. Now you might be thinking, I don't have any valuable skills. I thought that too. I spent $2,000 on a marketing course that honestly taught me things I could have just learned on YouTube for free. But I needed the structure and the deadline and the certificate to feel legitimate enough to charge money. Sometimes you need to pay for the confidence as much as the knowledge. Here's the thing about skills though. You can combine them to create something unique. Photography plus people skills equals wedding photography at $200 per hour. Finance knowledge plus teaching ability equals coaching at $125 per hour. Coding plus design sense equals UI UX work at $140 per hour. The combination is what makes you valuable. This is why months 3 through 5 look like a side hustle montage. You're testing what you're good at, what people will actually pay for, what you can stand doing for more than a week. By month 5, you should be earning at least $500 more per month than you were in month 1. That extra $500 per month for the next 20 years is $120,000 from 3 months of focused effort on a skill. Okay, so why do we eventually need to invest? 2 reasons. Reason 1, inflation is eating your cash. If you had $50,000 in 2000, it would buy you a house down payment in most cities, a full year of comfortable expenses, and a decent used car. That same $50,000 today buys you 8 months of rent in Phoenix, 4 months of family health insurance, or 3 used Honda Civics with 100,000 miles on them. Same money, way less stuff. Your $50,000 didn't disappear. It just buys less house, less healthcare, less car, less everything. This is why keeping cash under your mattress is basically a guaranteed way to get poorer every single year. Reason 2, compound interest. Compound interest means your money makes babies, and those babies make babies. And eventually, you have a whole family tree of money working for you. It's the only kind of reproduction that doesn't require child support. Here's what that actually looks like. $1,000 invested at 10% per year. Year 5, you have, $1,610. Year 10, basically double that, at $2,594. Year 20, $6,727. Notice that in year 1, you made $100, but in year 20, you made $612. Same investment, same rate. 6 times more money generated just because it had time to multiply. That first $1,000 you put in is still just $1,000. The other $5,727 is compound interest doing its thing. But here's the catch. Compound interest only works if you have money to compound. You can't compound $0. 0 times anything is still 0. You also can't compound money that keeps getting drained by emergencies. Invest $1,000, car breaks down, pull out $1,000, you're back to 0. This is why we spent months 1 through 5 building the foundation first. Because compounding works great in theory, but in practice it requires you to have surplus that you can afford to leave alone for decades. So what should you actually invest in? Not individual stocks. Let me show you why. Intel stock in 2000 was trading at $72 per share. People were excited. Tech was booming. If you bought Intel at that peak, guess what? 24 years later, you still haven't made your money back. That stock is still underwater. Meanwhile, the S&P 500 since 2000 has given you 4 times your money. Same time period. One choice lost money for 2 decades. The other quadrupled. This is the problem with picking individual stocks. You're betting that you're smarter than the entire market. And statistically, you're probably not. I'm definitely not. I thought picking stocks would make me rich. I was down 30% in 6 months. Turns out I'm very good at buying high and selling low. But here's what works. Index funds. An index fund is basically buying tiny pieces of 500 companies at once. It's like a buffet. You don't pick individual shrimp and try to guess which one is best. You just get the whole spread. Here's how it works. A mutual fund is when investors pool money together and pay a professional manager to pick stocks. That manager charges a fee for this service. An index fund is the same idea, except there's no manager. It automatically tracks an index like the S&P 500, the top 500 companies in America. No human picking, no guessing, just automatic tracking. Since there's no manager, the fees are way lower, and this is where it gets infuriating. Active fund managers, the ones charging you to pick stocks, beat the market about 8% of the time. 8%. But 100% of them charge you for trying. Let me show you what those fees actually cost. Say you invest $100,000. Option 1, actively managed fund charging 1% per year. Option 2, index fund charging 0.03% per year. Over 30 years at 8% growth. The 1% fee costs you, $28,000 over 30 years. The index fund fee, $800. The difference is $27,200. That 1% fee doesn't sound like much, until you realize you just donated a Honda Accord to your fund manager. Hope they enjoy it. Here's the other thing about trying to time the market. Missing the best days destroys your returns. If you invested in the S&P 500 over the past 30 years, but missed just the 10 best days, you'd lose 54% of your gains. Miss 20 days, lose 73%. Miss 30 days, lose 83%. The best days often happen right after the worst days. So if you panic and sell during a crash, you miss the recovery. This is why the strategy is just keep buying. Market high, buy. Market low, buy. Market crashing, buy. Market at all-time highs, buy. Because trying to time it means you'll probably miss the days that matter most. Months 6 through 10, build your 6-month emergency fund. Take your monthly expenses, the bare minimum you need to survive, and multiply by 6. That's your target. Put it in a high-yield savings account,
Stay
not the
away
stock
from
market.
volatile
I know some
stocks.
financial advisor somewhere is screaming that emergency funds should be invested for better returns. I tried that. Kept my emergency fund in stocks because compound interest and growth and all that. Then 2008 happened. Needed that money. It was down 40%. I am not a smart man. Your emergency fund has one job. Be there when everything goes wrong. It needs to be stable. It needs to be accessible. It cannot fluctuate with the market because emergencies don't wait for the market to recover. Here's what happens in your brain when you cross that 6-month threshold. You go from survival mode to growth mode. Survival mode is when every decision is about not dying financially. Growth mode is when you can start thinking about opportunity instead of just avoiding disaster. Psychologists have studied this. When you're in scarcity mindset, your IQ effectively drops. Not because you're stupid, because your brain is busy calculating whether you can afford groceries this week. Once you hit about, I want to say $12,000 saved, that scarcity fog lifts. You start seeing opportunities you couldn't see before. You make better decisions because you're not panicking. This is the real value of the emergency fund. Month 11, invest $1,000. Not in the market, in yourself. One more time. A self-paced online coding course, a sales certification, a project management course, whatever skill increases your earning power. Here's the math on this. Spend $1,000 on training. That training helps you negotiate a $20,000 raise. You start earning that extra money immediately. How long until you break even? Like 18 days. Less than 3 weeks. 18 days of that higher salary pays back the entire training cost. Then it's pure profit for the next 20 years. Compare that to investing $1,000 in the stock market. At 10%, you make $100 the first year. After 1 year, the skill investment has made you $20,000. The market investment has made you $100. That's a 200 to 1 difference. This is why month 11 is not about buying VOO yet. Month 12, now you're ready. Open a Fidelity or Schwab account. Buy VOO or SPY. These are ETFs that track the S&P 500. Set up automatic investing, $500 per month if you can. Dollar cost averaging. That means you buy every month no matter what the price is. High price, you buy fewer shares. Low price, you buy more shares. Over time, it averages out. You stop obsessing over whether now is the right time, because the right time is always now if you're buying consistently. $500 per month is $6,000 per year. At 8% growth over 35 years, that becomes $1.1 million from just starting in month 12 and being consistent. So why this order? Why not just invest immediately like everyone tells you? Because when you have $0, the stock market can't help you yet. Compound interest needs money to compound. Emergency funds need money to fund emergencies. You can't build wealth when you're constantly putting out financial fires with money you don't have. By month 12, you're not the same person who started this plan. You're not starting with $0 anymore. You have $2,000 in quick access cash for small emergencies. You have $12,000 in a full emergency fund for big problems. You have higher income because you invested in skills that actually pay you back. And now finally, compound interest has something real to work with. The financial industry tells you to invest immediately because they profit from your contributions. The more money flowing into their funds, the more fees they collect. I'm telling you to build a foundation first because that's what actually works when you're broke. The market doesn't care if you're desperate. It doesn't care if you need that money next month. It'll crash right when you need it most if you're unlucky. This is why the foundation comes first. I spent 2 years following the generic advice. Just invest early, time in the market, don't try to time it, all the cliches. And I stayed broke because I was solving the wrong problem first. I was trying to build wealth before I built stability. Doesn't work. Start with month 1. $2,000. 10-day sprint. Cut everything non-essential. Prove to yourself you can do this. Then months 3 through 5, increase your income. Find the skill that pays. Sell it. Months 6 through 10, build that emergency fund. Get out of survival mode. Month 11, invest in yourself one more time. Month 12, finally start investing in the market. By then, you'll actually be ready for it. Your future self is counting on the decision you make right now. Trust me, they'll thank you for it. Probably while sitting on a beach somewhere your current self can't afford yet.